Welcome to Hedge Haven, where we break down the complexities of global finance, luxury investing, and billionaire wealth strategies into insights you can actually use. In today's video, we're tackling a topic that's both timely and essential: the real impact of tariff delays and whether a temporary 90-day pause can actually save you money. Buckle up, because we're going deep into trade wars, consumer pricing, investor behavior, and economic policy, all with an eye on your wallet. Tariffs, on the surface, they seem like a distant concern, the kind of thing that only economists, policymakers, or multinational CEOs really need to worry about. But in reality, tariffs affect all of us, directly and indirectly. They're not just numbers in a spreadsheet or lines in a trade agreement. They translate into price changes on the goods we use every day. From smartphones and laptops to groceries and cars, the effect of tariffs quietly permeates our day-to-day lives. And when governments propose delaying those tariffs, like in the recent push to pause them for 90 days, the immediate question becomes, will that actually help regular people? Will it offer meaningful financial relief? Or is it just a political maneuver that kicks the can down the road? To understand this, we need to start with what tariffs are at a fundamental level. Tariffs are essentially taxes that a country imposes on imported goods. When a U.S. retailer imports sneakers from a factory in Vietnam or semiconductors from Taiwan, a tariff adds an extra cost to that transaction. That added cost doesn't just vanish, it trickles down to the consumer. It's baked into the final retail price. This is why when tariffs rise, prices often follow. It's also why a delay in implementing or increasing those tariffs has the potential to stall price increases, at least temporarily. Let's examine this through the lens of the current global economic landscape. We are living in a highly interconnected world where goods flow freely across borders, and the global supply chain functions like a finely tuned orchestra. When tariffs are suddenly introduced or increased, it's like throwing off the conductor's rhythm. Every section of the orchestra feels the impact. The disruption is felt not just by exporters and importers, but by middlemen, distributors, retailers, and ultimately you, the consumer. A 90-day delay, therefore, is essentially a grace period, allowing the orchestra to reset, retune, and perhaps realign their sheet music before the chaos begins again. But how much difference can 90 days really make? That's where things get interesting. A delay in tariffs can potentially benefit everyone in the chain. Manufacturers have time to reroute supply lines, businesses can stock up on inventory before costs rise, and consumers might get a short reprieve from rising prices. However, this temporary relief often comes with complications. Businesses may rush to import goods before the tariff kicks in, which can strain ports and logistics providers. This sudden surge in activity can create backlogs and bottlenecks that ironically lead to other forms of inflation or delays. Now let's dig deeper into how these 90-day tariff delays actually play out in real-world economics. Consider a retailer that imports electronics from Asia. Suppose that company knows a 10% tariff will hit in 3 months. They have a decision to make: either bring in as much inventory as they can during the grace period, or wait and risk higher costs later. Most businesses, especially large retailers, will opt for the former. They'll scramble to import massive quantities of goods, filling up warehouses in anticipation of the tariff increase. That rush creates artificial demand. Not consumer-driven demand, but supply chain-driven demand, which can create short-term distortions in the market. Warehouses fill up, shipping lanes become congested, ports start to choke under the pressure, logistics companies begin charging premium fees due to the sheer volume of demand. These are hidden costs that eventually show up in consumer prices anyway. Even when a tariff is delayed, these downstream effects can offset the short-term financial benefits. In other words, you might not see prices drop immediately, and in some cases, you may actually see them spike temporarily. The retail industry is a particularly good lens through which to study this. Think about fast fashion companies like Zara or H&M. These businesses rely on ultra-efficient global supply chains that move goods from design table to store shelves in a matter of weeks. A sudden change in tariff structure, or even the threat of one, throws that agility into chaos. A 90-day pause may give them a window to accelerate orders, renegotiate with suppliers, or change sourcing strategies, but it also adds uncertainty. And in business, uncertainty is costly. It forces companies to hedge their bets, often by raising prices or reducing inventory, which impacts consumer choice. Meanwhile, let's talk about technology, one of the most tariff-sensitive industries out there. Smartphones, laptops, smart TVs, gaming consoles, all these gadgets rely on complex global supply chains involving parts from multiple countries. A single smartphone might have components sourced from South Korea, assembled in China, programmed with software in the US, and shipped to consumers in Europe. If any leg of that journey becomes more expensive because of tariffs, the end price reflects that. A 90-day delay in tariffs might allow tech companies to front-load production, secure parts at pre-tariff rates, and pass some of those savings on to consumers. But this also creates a bullwhip effect, where demand swings wildly due to supply chain distortions. Retailers overorder, suppliers ramp up production, and when the tariffs finally kick in, everything slams on the brakes. For consumers, this manifests as price volatility. You might see a product go on sale for a few weeks, only to spike in price a month later. Or you might find that an item you want is out of stock because the manufacturer pulled back after overproducing during the delay window. It's a roller coaster, and that's just in stable economic conditions. Add inflation, interest rate changes, and geopolitical tensions to the mix, and the picture becomes even murkier. Another consequence of 90-day tariff delays is the strategic behavior it encourages in corporations. Large companies with deep pockets often game these windows. They hedge currency risks, hoard inventory, and even manipulate accounting timelines to maximize short-term gains. Small and medium-sized businesses, on the other hand, don't have that luxury. They operate on tighter margins and shorter planning cycles, which means they can't adapt as quickly. This leads to an uneven playing field. Big companies get stronger, small businesses suffer, and consumer choice diminishes in the long run. And then there's the matter of perception. Even if the prices don't rise right away, the psychological effect of tariff talk can alter consumer behavior. People may postpone big-ticket purchases, expecting deals before tariffs hit. Others may rush to buy, fearing that prices will skyrocket. Both behaviors have economic consequences. Delayed purchases slow economic activity. Panic buying distorts demand forecasts. Either way, consumer confidence is shaken, and that's bad news for any economy trying to stabilize. Now, zooming out from the consumer level, let's look at the broader macroeconomic implications of delaying tariffs for 90 days. In economic theory, tariffs function as both fiscal tools and strategic levers in international diplomacy. When a government announces a new tariff and then delays it, this move sends mixed signals, not just to the market, but to other governments and global investors. It introduces an element of policy uncertainty. Investors hate uncertainty. Businesses too. Delaying tariffs, rather than removing them or fully enforcing them, creates a gray zone that complicates forecasting models, investment decisions, and trade planning. For example, a multinational company looking to expand manufacturing into the US might put those plans on hold, unsure whether trade will remain free-flowing or more restricted after 90 days. This indecision drags down capital investment. Let's say you're a US manufacturer considering sourcing steel domestically versus importing it from China. A tariff delay means you don't know which option will be cost-effective in 3 months. Do you lock in long-term domestic contracts at higher rates? Or do you gamble and bulk import foreign steel now, hoping to beat the clock? In either case, the lack of clarity impacts efficiency, pricing, and growth. Multiply this indecision across every sector, from automobiles to pharmaceuticals, and you can see how a simple delay can cause ripple effects across the economy. For small manufacturers, this is a nightmare scenario. Many operate on thin margins and can't afford large-scale inventory hoarding or speculative pricing strategies. A 90-day delay might sound generous in political messaging, but in practice, it's often too short for meaningful restructuring and too long to maintain status quo pricing. There's another important dynamic at play: employment. Industries that depend on predictable trade flows, such as logistics, warehousing, retail, and manufacturing, may see fluctuations in staffing needs during tariff delay periods. In the first month of the delay, there may be a hiring surge to cope with increased shipments and production. But as the deadline approaches, those same firms might begin laying off temporary workers, freezing hiring, or cutting hours in anticipation of an economic slowdown when the tariffs hit. This contributes to labor market instability, particularly among low-wage or hourly workers. It also contributes to income volatility, which in turn affects consumer spending, creating a vicious cycle. Now let's go beyond domestic borders. Tariff delays don't just affect the U.S. economy, they send ripples across global markets. Exporting countries often interpret delays as negotiating tactics rather than sincere efforts to reduce consumer burden. Take China, for instance. If the U.S. announces tariffs on electronics and then delays enforcement for 90 days, Chinese exporters may flood the U.S. market during that window, driving short-term trade imbalances. This oversupply can temporarily lower prices for American consumers, but also increase dependency on imported goods, undermining long-term goals of trade, self-sufficiency. And when the tariffs finally go into effect, retaliatory measures often follow. So the initial delay may actually increase tensions rather than reduce them. Consider the agricultural sector. In the past, when the U.S. delayed tariffs on foreign agricultural imports, countries like Brazil and Argentina responded by dumping surplus crops into U.S. markets. This might sound like good news for consumers, but for American farmers, it's devastating. Domestic producers get undercut, lose market share, and are sometimes forced to reduce output or shut down altogether. Once tariffs are reinstated, these same farmers have to rebuild from a weakened position, often relying on government subsidies just to stay afloat. In essence, tariff delays can undermine domestic industries in the name of short-term price stability, and taxpayers end up footing the bill anyway, just through a different mechanism. At the household level, the psychology of spending plays a huge role in how tariff delays are felt. A family considering buying a new refrigerator might read headlines about tariff delays and decide to wait a few weeks, hoping for a better price. Another family, anxious that prices could rise after 90 days, might rush to make the purchase now. Both scenarios reflect the power of perception in economic behavior. Consumers don't need to fully understand trade policy to act on it. They only need to believe that tariffs will impact their wallets, and this belief becomes self-fulfilling, driving demand up or down depending on the prevailing sentiment. Now consider how retail giants respond to tariff delays. Companies like Walmart, Target, and Best Buy are often the first to make large-scale purchasing decisions based on incoming tariff news. If a 10% tariff is delayed for 90 days, their supply chain executives may place accelerated bulk orders from overseas manufacturers in an attempt to front-load inventory before the higher costs kick in. This tactic is called tariff front-running, and while it may stabilize prices in the short term, it causes dramatic spikes in warehouse storage needs, freight costs, and port congestion. In fact, during prior U.S. tariff announcements, especially in 2018 and 2019, some U.S. ports saw record import volumes ahead of implementation dates. This rush led to shipping container shortages, higher ocean freight rates, and logistical bottlenecks. Now add to this the phenomenon of consumer panic buying. Just as businesses rush to secure inventory, consumers begin to adopt a similar mindset when delays are announced. If media coverage frames the 90-day delay as a countdown clock, individuals may stock up on electronics, appliances, or imported foods while prices are perceived to be temporarily suppressed. This surge in buying can create artificial demand, depleting inventories faster than expected, and straining retailers' restocking capacities. When shelves run empty and replacements arrive post-tariff, the new higher prices seem even more jarring, sometimes leading to consumer frustration and backlash. For low to middle-income households, this kind of price shock can throw off monthly budgets, limit discretionary spending, and reduce overall economic confidence. An important but often overlooked element in this conversation is the role of currency fluctuations. During periods of tariff uncertainty, especially with delays, currencies tend to move based on investor speculation. For example, if markets anticipate that U.S. tariffs will be enforced after 90 days, the U.S. dollar may strengthen temporarily due to a perceived hardline stance on trade. This stronger dollar makes imported goods slightly cheaper during the delay, adding a layer of price stabilization. But when the tariffs finally hit and retaliatory measures come into play, currencies often swing the other way. weakening the dollar and further compounding price increases. For consumers, this adds another hidden layer of unpredictability to the cost of imported goods. You might pay less for that TV today, but dramatically more 3 months from now, even if the product's the same. There's also the digital economy to consider. A growing number of Americans buy goods directly from overseas platforms, AliExpress, Shein, Temu, and others. These companies often ship products individually to bypass certain customs thresholds. Tariff delays can temporarily preserve these loopholes, maintaining ultra-low pricing on everything from phone cases to clothing. But when delays end and tariffs are enforced across categories, those same products become noticeably more expensive. This hurts consumers who rely on budget e-commerce options and further exacerbates income inequality. Wealthier households may be less sensitive to a $15 price hike on a $100 purchase. But for lower-income families, those few extra dollars can mean the difference between affording essential goods or not. Beyond consumers, small businesses that rely on imported materials or resell imported products are caught in a dangerous limbo during a 90-day tariff delay. Many lack the capital to bulk purchase inventory ahead of time. They also lack the influence to negotiate supplier discounts in anticipation of future tariff costs. A small furniture importer in New Jersey, for example, might find themselves forced to increase prices after 90 days, while larger competitors who stocked up early can maintain their price points. This asymmetry erodes competitiveness in local economies, reducing small business viability and increasing market concentration. Fewer choices and higher prices become the norm. Let's now look deeper into the global supply chain distortions caused by the uncertainty surrounding a 90-day tariff delay. Modern global trade is highly interconnected. A single product, such as a smartphone, often passes through more than 20 countries during production. When the United States announces a delay on tariffs, it sends a ripple effect through these global manufacturing hubs. For instance, a delay on tariffs targeting Chinese electronics might cause a surge of demand in Chinese factories. These factories, in turn, demand more microchips from Taiwan, more raw materials from Australia, and more labor input from Southeast Asia. The sudden spike in demand due to the looming tariff deadline leads to overbooked production schedules, temporary labor shortages, and stressed shipping routes. This pattern continues as manufacturing timelines compress. Companies rush to push orders through before the tariff window closes. Ports in China, Vietnam, and South Korea report surges in container volumes during such tariff reprieves, causing port congestion, delays, and container shortages in other markets like Europe and Latin America. These distortions are not immediately visible to the average U.S. consumer, but they show up subtly through out-of-stock items, longer delivery times, and incremental price hikes across both imported and domestically assembled goods. When the U.S. consumer wonders why a certain product now takes 3 weeks instead of 3 days to arrive, the root cause often traces back to this domino effect triggered by tariff policy fluctuations. Even more problematic is how large multinational corporations manipulate such delays to gain unfair leverage. Let's take the example of a U.S.-based electronics conglomerate. Upon hearing about a 90-day delay in tariffs on Chinese-made chips, it might redirect shipments from Vietnam to China, just for the short window, to capitalize on lower costs. This artificial rerouting disrupts long-standing trade relationships and skews supply-demand signals across regional economies. Smaller countries trying to build consistent export markets find themselves sidelined every time the U.S. changes direction. This stop-and-start nature of trade policy undermines long-term global stability, and ironically, it reduces the effectiveness of tariffs as a deterrent against unfair practices. Then there's the issue of geopolitical signaling. Tariffs, when delayed, are often used as a tool of negotiation rather than enforcement. For instance, the U.S. might announce a 90-day delay in steel tariffs to incentivize the European Union into agreeing to new carbon emission standards. While this kind of leverage is common in diplomacy, it sends confusing signals to investors, manufacturers, and consumers alike. Is the delay a show of goodwill, a bluff, or a tactical pause before escalation? The uncertainty it generates can lead to paralyzed decision-making in boardrooms and households. If you're a business considering a capital investment, Like opening a new factory or expanding a product line, a 90-day tariff delay may cause you to wait it out, which slows down economic activity. If you're a consumer planning to buy a new car made with imported aluminum, you might hold off until the delay expires, hoping to catch a better price. This wait-and-see behavior can drag on demand and mute economic momentum. One of the most overlooked consequences of tariff delays lies in their effect on speculative trading and financial market behavior. Modern financial markets are hypersensitive to trade policy shifts, and even a whisper of a 90-day tariff delay can ignite significant volatility across asset classes. Consider commodities. If the U.S. announces a temporary suspension of tariffs on Chinese aluminum or Canadian steel, futures traders respond almost instantly. Prices may fall on expectations of lower input costs for manufacturers. Conversely, if the delay is perceived as short-lived and likely to reverse, prices might actually spike due to anticipated future shortages or retaliatory actions by affected countries. Stock markets respond with equal fervor. Companies whose profit margins depend on imported goods, like tech firms, car manufacturers, and retail giants, may see their stock prices rise during a tariff delay as investors project short-term cost savings. But these reactions are often short-lived. Once the delay ends, uncertainty returns, and stock values can tumble. This boom and bust cycle creates whiplash for retail investors and erodes long-term confidence. For institutional investors like hedge funds, however, these temporary windows offer lucrative arbitrage opportunities. They can load up on undervalued stocks, short commodities expected to fall, or reposition their global portfolios, all in anticipation of a policy change just weeks away. This environment fosters reactive investing rather than strategic wealth building. For the everyday consumer with a 401k or an IRA, these sharp swings may not be visible daily, but they affect mutual fund valuations and ETF performance. Over the long term, the lack of predictability in trade policy erodes the consistency of returns. It also causes capital flight from more exposed sectors, such as industrials or manufacturing, to perceived safe havens like technology or pharmaceuticals, ironically amplifying market concentration risks. Then there's the role of currency markets. A 90-day tariff delay may temporarily strengthen the US dollar as global investors interpret the move as a de-escalation of trade tensions. A stronger dollar makes imports cheaper, which is good news for consumers, but it simultaneously makes US exports less competitive, which hurts American producers. Over time, this trade imbalance feeds into GDP revisions, employment shifts, and consumer spending habits. In a country where consumption accounts for nearly 70% of economic activity, these ripple effects are far from trivial. Let's also consider the psychological effects on consumer behavior. The average consumer might not follow every tariff announcement, but they do respond to pricing trends. A 90-day delay might slow down rising costs temporarily, giving people a false sense of economic relief. This perception can trigger a brief increase in discretionary spending, vacations, luxury goods, even home renovations. However, when tariffs are reimposed or new ones introduced, that confidence disappears. Families begin tightening budgets again, cutting back on non-essential items, and shifting purchases toward discount retailers or store brands. Retailers know this, and many adjust their pricing strategies accordingly. For example, a retailer might offer heavy discounts during a tariff delay to clear inventory before future price hikes. Others may stockpile foreign goods during the 90-day window and use the savings to subsidize prices for the rest of the year. This makes it difficult for consumers to know whether they're getting a fair deal or being manipulated by short-term pricing tactics. All of this underscores one key point. While tariff delays seem like a simple policy tweak on the surface, their effects cascade through financial markets, business behavior, and consumer psychology in profound ways. Now let's delve deeper into how businesses, both large corporations and small enterprises, respond during a tariff delay. For multinational corporations, a 90-day postponement on tariff imposition is not just a pause, it's a strategic window. These businesses often operate with extensive forecasting and procurement timelines, meaning they don't just react, they mobilize. Procurement departments may rush to place massive inventory orders during the tariff-free period. Warehouses swell with imported goods, especially electronics, machinery parts, and raw materials that would become significantly more expensive once tariffs are enacted. This practice, known as front-loading, can lead to temporary spikes in imports. Ports become congested, shipping costs rise due to sudden demand surges, and trucking bottlenecks form across major transportation hubs. While this influx of goods might initially seem like a win for consumers due to temporarily stable prices, it creates logistical inefficiencies. Delays in customs clearance, higher demurrage charges, and overwhelmed freight handlers all result in increased hidden costs. Ironically, these operational frictions can erode the very price stability the delay was meant to protect. Small and medium-sized enterprises, SMEs on the other hand, often lack the financial muscle or warehousing space to front-load. These businesses remain vulnerable during tariff uncertainty. They may struggle to lock in favorable supplier contracts, hedge currency risks, or pass on costs to consumers without losing market share. For them, a 90-day delay offers limited relief, more like borrowed time than a solution. These SMEs often operate with tighter margins and shorter planning cycles. They must decide whether to absorb future tariff costs, reduce quality, or raise prices. And none of those decisions are easy. In sectors like automotive manufacturing, the stakes are even higher. Vehicles often require thousands of components sourced globally. Even a minor tariff on brake systems or onboard electronics can ripple through the supply chain, forcing manufacturers to alter designs or renegotiate vendor contracts. A delay in tariffs might give them breathing room to explore alternative suppliers or shift some production domestically. But reshoring production isn't instantaneous. It takes months or years. So the 90-day window, while valuable, is not a panacea. It often merely postpones difficult decisions. Retailers, especially big box chains and e-commerce platforms, see a tariff delay as a marketing opportunity. You'll often see beat the tariff sales or price lock during trade freeze, campaigns that capitalize on consumer anxiety. These tactics drive short-term sales but also contribute to long-term confusion. Consumers begin associating pricing with government decisions rather than supply and demand, which distorts their perception of value. A product may appear cheaper simply because it's being promoted during a tariff pause, even if its price hasn't actually changed. Another sector deeply affected is agriculture. U.S. farmers are particularly sensitive to both direct tariffs and retaliatory tariffs from other nations. A delay in U.S.-imposed tariffs might lead countries like China or the EU to temporarily ease their retaliatory duties on American soybeans, pork, or corn. This creates a brief resurgence in export volumes, offering farmers a glimmer of hope and a chance to move surplus inventory. But this rebound is fragile. If the tariff pause ends without a clear resolution, retaliatory tariffs return, and farmers are once again left scrambling. Additionally, insurance companies, particularly those involved in shipping and cargo, reassess risk premiums during these policy windows. A stable trade environment lowers the likelihood of cargo rerouting, customs disputes, or perishable goods being stuck at borders. During a 90-day delay, premiums might drop slightly, offering modest cost savings to importers. But again, these are fleeting benefits, undone quickly if trade tensions resume or if the delay ends with harsher measures. In essence, businesses view the delay not as a resolution, but as a breathing space for strategic adaptation. Those with agility and foresight can leverage it for short-term advantage. Those without such capacity often find themselves at greater risk when the pause ends and tariffs snap back into place, sometimes with retroactive penalties or stricter enforcement. Now let's examine how tariff delays interact with inflationary pressures in an already volatile economic environment. In most modern economies, especially those like the US, UK, Germany, and Canada, inflation is influenced by a web of interconnected variables: supply chains, consumer confidence, energy prices, labor markets, and yes, trade policy. A tariff is not just a tax on goods, it's a force that can directly feed into the inflationary spiral. When a government delays tariffs, it is temporarily holding back a contributor to rising prices. But whether that successfully tempers inflation depends on timing, scale, and global conditions. Imagine the economy like a pressure cooker and tariffs like additional heat. When tariffs are delayed, you slightly reduce the flame, but the pot is still under pressure from other sources: rising oil prices, geopolitical instability, wage growth, and commodity scarcity. In this context, a 90-day delay might not dramatically cool inflation, but could momentarily slow its acceleration. Here's where it gets tricky. Central banks, like the Federal Reserve or the European Central Bank, are constantly monitoring inflation signals to adjust interest rates. A temporary drop in import prices due to a tariff delay can lead to misread signals. If central banks interpret the softening prices as a sign of sustainable inflation control, they may pause interest rate hikes or loosen monetary policy. But when tariffs snap back in after 90 days and prices rise suddenly, they may have to reverse course abruptly, hiking rates again. This creates a stop-start pattern in monetary policy, unsettling markets and weakening investor confidence. For consumers, this back-and-forth movement in prices is confusing. 1 month imported furniture is affordable. 3 months later, it's significantly more expensive. The same goes for electronics, auto parts, and even grocery store items. This volatility influences how consumers spend. They may rush to purchase big-ticket items during the delay window, which creates short-term demand shocks. But this burst in consumption isn't sustainable and often followed by sharp drop-offs when prices rise again. In fact, consumer behavior during a tariff delay mirrors reactions to inflation surges. People stockpile. They delay discretionary purchases if they fear future price hikes. Or conversely, they engage in a form of economic panic buying. All of this distorts normal supply and demand, making it harder for retailers, wholesalers, and manufacturers to forecast accurately. We also need to consider the psychological effects of policy uncertainty. A 90-day delay doesn't resolve anything. It just adds a countdown clock to an already anxious public. Business owners, investors, and everyday consumers begin to operate in a kind of countdown mentality. Will tariffs go into effect next quarter? Should I make major purchases now or wait? This economic indecision suppresses long-term investment and delays household financial planning. It's like trying to build a house during an earthquake. You're unsure if the ground will stabilize or tremble again. There's also the question of how such tariff delays affect employment. In sectors that rely heavily on imports, like electronics retail, construction, and auto repair, a delay might maintain job stability temporarily. Businesses may avoid layoffs knowing they have a few tariff-free months to make up for past losses or move inventory. But the delay also discourages companies from hiring. Why expand your workforce when you're unsure if operating costs will spike again in 90 days? As a result, we often see stagnant employment growth, even when GDP or retail sales experience a short-lived uptick during the delay window. From a policy standpoint, governments walk a tightrope. Delaying tariffs can help appease consumer outrage, smoothen public sentiment ahead of elections, or signal diplomatic goodwill. But such delays can also appear weak or indecisive, especially in trade negotiations. If other countries sense hesitation, they may stall in making concessions, knowing that public pressure could push the delaying country into further postponements. It weakens negotiating leverage and complicates bilateral trade talks. Furthermore, the stock market's reaction to tariff delays can be erratic. Equity markets might rally on news of a 90-day delay, especially in sectors like tech, retail, and automotive. But these rallies are often short-lived, corrected by analysts and institutions who see through the temporary nature of the reprieve. You may see headlines like, "Markets jump on tariff delay," followed by "Gains erased on uncertainty of future trade policy" just weeks later. This cycle feeds volatility and makes long-term investing riskier. All of these dynamics bring us back to one core idea: a tariff delay is a pause, not a fix. While it can deliver momentary relief, it does not address the underlying causes of price instability, supply chain fragility, or global trade imbalances. It buys time for businesses to adjust, for consumers to prepare, for policymakers to negotiate. But time is not a solution in itself. Let's now delve into the long-term structural risks that tariff delays tend to obscure. At first glance, a 90-day delay may appear harmless, even helpful. It gives the market time to breathe, allows manufacturers to reroute supply chains, and gives policymakers room to renegotiate trade deals. But underneath this short-term calm lies a more complex issue: systemic dependency on unstable trade relationships. Many industries, particularly consumer electronics, apparel, and auto manufacturing, have spent decades building lean, just-in-time global supply chains. This model was designed for efficiency, not resilience. Companies source parts from low-cost countries, ship them across continents, and assemble them where labor or tax conditions are most favorable. The moment you introduce tariffs, or the threat of them, this delicate chain is disturbed. A delay in tariffs only postpones the pressure, but doesn't eliminate the need for supply chain diversification. In fact, it often creates strategic procrastination. Instead of investing in long-term solutions like onshoring, reshoring, or building redundancies, many firms opt for temporary measures: stockpiling inventory, accelerating orders, or lobbying for further delays. This reactive behavior puts companies, and by extension, consumers, at greater risk in the long run. If the tariff clock restarts unexpectedly or geopolitical tensions escalate, these unprepared businesses may be forced into crisis mode. Prices could skyrocket overnight, job losses could mount, and access to goods could diminish rapidly. Consumers unaware of these structural vulnerabilities are often blindsided. They might wonder why a product that cost $500 last quarter now sells for $750, not realizing that a delayed supply chain reconfiguration has finally caught up to them. Tariff delays can also contribute to price whiplash, where the cost of goods rises and falls unpredictably. This undermines price transparency, a key component of efficient markets, and erodes consumer trust. There's also the issue of political exploitation. In democratic nations, especially during election cycles, politicians may use tariff delays as a tool for voter appeasement. Delaying tariffs can be framed as a win for the average citizen, even though it postpones rather than solves the problem. This political theater may gain short-term approval, but can hollow out serious debate on long-term trade reform. Voters are left with the illusion of progress, while economic imbalances persist beneath the surface. Let's not forget the environmental dimension of tariff delays. Global trade isn't just about economics. It's deeply entwined with climate change. Many of the most heavily imported goods come from countries with laxer environmental regulations or higher carbon footprints in manufacturing. Tariff structures are sometimes used to incentivize cleaner production methods or penalize pollution-intensive industries. By delaying these tariffs, countries may unintentionally extend the life of environmentally damaging supply chains. For consumers trying to make ethical, sustainable purchases, this adds another layer of confusion and compromise. We also need to discuss how tariff delays interact with emerging market economies. When a developed country like the US delays tariffs on imports from a developing country, it may be seen as a relief. Exporters in those countries maintain access to lucrative markets. But the uncertainty around these delays often discourages long-term investments in quality, labor rights, and innovation. If manufacturers in Bangladesh or Vietnam don't know whether they'll face tariffs in 3 months, they're unlikely to upgrade factories or invest in worker training. This policy whiplash creates instability on both ends of the trade equation. From a macroeconomic standpoint, tariff delays distort global trade signals. Markets rely on clear rules. Delays muddy those waters. Supply chains become more speculative. Inventory management becomes erratic, and price setting becomes guesswork. Retailers may overorder in anticipation of a tariff snapback, only to be left with excess inventory if delays are extended. Or worse, they may underorder during a delay, leading to stockouts when tariffs finally hit and demand remains high. There is also a psychological cost to all of this. Consumers begin to internalize economic anxiety, even if their individual financial situation hasn't changed yet. Constant media coverage about looming tariffs, price hikes, and supply chain issues cultivates a sense of fragility. This is what economists call demand destruction by sentiment. People spend less not because they can't afford to, but because they're afraid to. A 90-day delay does little to resolve the psychological unease. In fact, it can exacerbate it by drawing out the uncertainty. And finally, let's turn to technological adaptation and innovation, or rather, the lack thereof. Tariffs are often catalysts for innovation. When imported goods become expensive, domestic producers have an incentive to compete by improving quality, lowering costs, or automating production. Delaying tariffs removes that pressure. It creates a false sense of comfort for domestic industries that may already be lagging behind global competitors. Rather than invest in R&D, they may continue operating with outdated technologies and bloated cost structures, weakening national competitiveness over time. In essence, while a 90-day delay on tariffs may appear consumer-friendly on the surface, it can quietly erode the economic, political, and environmental foundations upon which stable global commerce rests. Now let's pivot to one of the most underestimated aspects of tariff policy: the weaponization of uncertainty. In modern geopolitics, uncertainty itself has become a strategic tool. Tariff delays, especially those that come with vague conditions or ambiguous end dates, are increasingly used not to provide relief, but to create leverage. For example, when a powerful economy imposes a 90-day tariff delay, it's rarely about mercy or economic stewardship. It's often a calculated move to pressure trade partners, unsettle competitors, and test the political cohesion of allied nations. Let's unpack that. Consider a situation where country A dominant economy, delays tariffs on imports from country B, a smaller yet strategically important nation. Country B, relieved by the delay, may interpret it as goodwill. But in reality, country A may use the delay to extract concessions, better trade terms, intellectual property compliance, digital tax reforms, or geopolitical alignment on unrelated issues. The delay becomes a bargaining chip, an open-ended threat, and an unspoken deal. If country B resists, the tariffs can be activated instantly. If it complies, the delay may be extended or turned into exemption. This kind of geoeconomic coercion plays out in back channels, behind press releases and diplomatic photo ops. In financial markets, this weaponized uncertainty bleeds into investment decisions. Institutional investors don't like unclear rules. A tariff delay without a clear expiration or roadmap creates volatility. Asset managers can't model earnings, analysts can't project costs, and multinational firms can't budget for the next fiscal quarter. The result? Defensive investing. Capital gets parked in cash, gold, or short-duration government bonds. Growth slows, not because of interest rates or inflation, but because the rules of engagement keep shifting. The opportunity cost of policy ambiguity becomes a drag on global GDP. Meanwhile, hedge funds and high-frequency trading desks exploit this volatility. Tariff announcements and delays move markets within seconds. A single headline about an extension or rollback can swing currencies, commodities, and equities. These moves aren't about fundamentals. They're about narrative dominance. Funds that understand how governments use tariff signals as psychological operations, not just economic tools, are the ones that consistently outperform. This is where geopolitical arbitrage meets financial engineering, and it's a space very few retail investors understand or access. Let's talk briefly about how this impacts employment, especially in developed countries. Tariff delays don't just affect companies, they affect people. When tariffs are threatened, companies pause hiring, they freeze raises, they delay capital expenditures, and when delays are extended, the uncertainty continues. Workers feel like they're living in a holding pattern. Should they switch jobs? Should they move? Should they buy that house or wait until the trade dust settles? This economic anxiety seeps into communities, especially in manufacturing-heavy regions. Over time, this builds resentment, not just against foreign competitors, but against domestic leadership that seems paralyzed by indecision. This is where populism finds fuel. Politicians can spin the narrative in multiple ways. One party may blame foreign nations for undercutting local jobs, while another blames homegrown corporations for offshoring production. Both sides cite the same delayed tariffs as evidence for their argument. The public, caught in the middle, struggles to parse the truth. They see the price tags rising, the shelves half-stocked, the factories quiet, but they don't see the lobbying battles, the WTO disputes, the bilateral negotiations unfolding in closed-door meetings. Tariff delays in this sense become the perfect political scapegoat, simultaneously actionable and abstract. Another layer of complexity emerges when we consider currency wars. When tariffs are delayed, currency traders often interpret it as a softening of economic policy. That can trigger a depreciation or appreciation of national currencies, depending on investor sentiment. If country A delays tariffs, it may see its currency weaken due to perceived dovishness. If country B is relieved of impending tariffs, its currency may strengthen. But none of this reflects real productivity or output. It's all speculative capital chasing interpretations. And that creates ripple effects for import-export pricing, sovereign debt servicing, and central bank interventions. This dance of tariffs and delays also impacts the global tax base. Many countries depend on customs duties for a significant portion of revenue, especially emerging economies. When a larger trading partner delays tariffs, the volume of taxed imports may drop. This shrinks tax revenue, forcing governments to either raise taxes elsewhere or cut public spending. Infrastructure projects stall, healthcare budgets shrink, education programs are deprioritized, all because of a tariff policy that wasn't even designed by the local government. This is the asymmetrical power of global trade rules. Let's not forget consumer behavior on the digital frontier. In today's globalized internet economy, consumers are no longer bound by geography. If tariffs are delayed on Chinese-made electronics, but speculation persists about a future tax hike, consumers may rush to buy now. This creates artificial spikes in demand, leading to temporary shortages, followed by overstocked inventory once the delay is extended again. Online retailers like Amazon, Temu, and Alibaba adjust their algorithms accordingly. Ads become more aggressive, discounts are front-loaded, but the consumer ultimately pays, not just in dollars, but in cognitive fatigue from navigating an unstable marketplace. And finally, let's talk about national strategic autonomy. Tariff delays can signal a lack of resolve in enforcing trade policy. For allies, this may erode confidence. For rivals, it may signal weakness. If a country publicly announces tariffs only to delay them under political or economic pressure, it creates a perception that its policies can be manipulated. This perception can undermine alliances, embolden adversaries, and weaken negotiating positions in forums like the G7 or World Trade Organization. A single 90-day delay can send a ripple of geopolitical doubt across dozens of capitals and boardrooms worldwide. So while the economic impact of a 90-day tariff delay is real, affecting prices, jobs, and supply chains, the strategic cost may be even greater. It undermines clarity, corrodes trust, and invites manipulation at every level of global commerce and diplomacy. The broader geopolitical implications of a tariff delay further deepen the narrative investors and consumers must navigate. It's not just about price points or short-term gains. Delaying tariffs touches on diplomacy, strategic alliances, and the balance of power in global trade. Consider the ripple effects such a move might have on relationships with major trading partners like China, the European Union, and Mexico. A 90-day pause might be interpreted differently by each stakeholder as a sign of negotiation, weakness, or strategic recalibration. Each interpretation carries consequences. For example, China may use the window to recalibrate its own export policies or tighten its grip on rare earth exports, key components for tech manufacturing. Simultaneously, European manufacturers might accelerate shipments to beat the tariff window, impacting inventory cycles, pricing, and freight costs across the Atlantic. For multinational corporations, these reactions require rapid adjustments in cross-border strategy, hedging currency risks, and reassessing quarterly forecasts based on shifting political winds. This diplomatic layer adds another complexity for institutional investors. Global funds managing billions must anticipate how foreign governments might react to a temporary delay in U.S. tariffs. Will retaliatory tariffs be suspended as goodwill? Will trade ministers interpret the delay as an opportunity to renegotiate terms or solidify regional alliances that bypass U.S. supply chains altogether? A 90-day window could be a geopolitical chessboard in motion. In this environment, smart money follows not only financial indicators but also diplomatic gestures, press briefings, and even subtle changes in policy language. For investors with high exposure to emerging markets, especially those dependent on U.S. consumption, these diplomatic shifts can either present arbitrage opportunities or signal flight risk scenarios, urging a pivot to safer assets or low volatility indexes. Beyond foreign policy, the corporate sector's psychological response during the delay is equally telling. Companies don't just sit idle during a tariff pause. Many expedite inventory stocking, especially in retail, electronics, and auto parts, effectively front-loading shipments to avoid potential price spikes post-delay. This anticipatory behavior creates artificial demand surges, temporary warehouse bottlenecks, and spikes in logistics costs. It's the bullwhip effect in action. A small shift in trade policy triggers disproportionate reactions down the supply chain. As a result, Q2 financial reports may show inflated revenues not from consumer demand, but from tariff-driven stocking strategies. Investors who read this incorrectly may perceive growth where there's only hedging against future pain. Therefore, market reactions during a delay may reflect optimism that's more speculative than substantive. Delving further into macroeconomic psychology, consumer sentiment becomes another vital variable. Surveys conducted during previous tariff pauses show that most consumers remain largely unaware of tariff specifics, but they do respond to price movements. If prices of everyday goods hold steady or drop slightly during the delay, consumers may interpret it as economic stabilization. This sentiment drives spending confidence, especially in discretionary categories like travel, luxury, and electronics. Conversely, if retailers use the delay to inflate prices under the guise of uncertainty, it can erode trust, reduce spending, and amplify consumer pessimism. Economic behavior is not just reactive, but anticipatory. Households often adjust budgets based on perceived future constraints, even if their current financial state remains unchanged. A less discussed but crucial component in the tariff delay conversation is the labor market, specifically how employers respond to temporary trade leniency. Manufacturing firms with overseas exposure may use the 90-day window to ramp up production, delay layoffs, or increase temporary hiring to meet short-term supply spikes. Conversely, uncertainty beyond the delay might lead to cautious HR policies, freezing new positions, reducing overtime, or avoiding capital expenditures that can't pay off in the short window. Labor economists observe that such volatility in hiring cycles disproportionately affects low-wage workers, gig economy participants, and seasonal laborers, groups most vulnerable to external shocks. Hence, even a tariff delay can produce very real disruptions in employment patterns and wage growth. Equally significant is how Wall Street interprets these labor signals. Analysts may parse job reports, production indices, and retail earnings during the delay to project long-term sector strength, but there's risk in over-indexing short-term spikes. A surge in durable goods orders during a tariff pause could mislead investors about underlying demand strength. Similarly, a drop in jobless claims might suggest labor market tightening when it's merely a byproduct of short-term corporate stockpiling. Misreading these signs can lead to mispriced equities, misplaced investor confidence, and poor portfolio performance. At the same time, small businesses, the backbone of many Western economies, face a uniquely challenging decision matrix during such delays. Unlike large corporations, small and medium enterprises, SMEs, lack the financial runway and legal teams to navigate tariff complexity efficiently. For an SME importing specialty goods or raw materials, a 90-day delay might seem like a lifeline, but that lifeline is threaded with ambiguity. Should they increase orders to beat future tariffs, risking excess inventory and cash flow constraints? Or should they wait, risking future price hikes and supplier delays? Their decisions influence local employment, urban economies, and regional tax revenues. Thus, the tariff delay isn't just a macroeconomic lever. It's a grassroots economic disruptor with tangible effects on families, communities, and local commerce ecosystems. Additionally, let's explore the behavior of financial institutions and hedge funds during such pauses. Hedge funds, by design, thrive in volatility and policy uncertainty. A 90-day delay creates the perfect environment for options trading, commodity speculation, and long-short strategies on tariff-sensitive sectors. For example, funds might short logistics firms expected to suffer post-delay due to overcapacity. Alternatively, they may go long on domestic producers that benefit temporarily from reduced foreign competition. The volatility premium during this window can be immense. Smart institutional players analyze port shipment data, customs clearances, and even satellite imagery of freight hubs to model real-time trade flow changes and adjust positions daily. Their advantage lies in speed and information asymmetry, but their activity also increases market turbulence that trickles down to retail investors. In the world of currency markets, a 90-day tariff delay can also lead to forex fluctuations, especially for currencies tied to export-heavy economies like the yuan, euro, or Mexican peso. If traders believe the delay signals future softening of trade tensions, they may increase demand for those currencies, strengthening them temporarily. Conversely, if the delay is seen as a prelude to a harsher tariff regime, investors may retreat to the US dollar or other safe haven currencies like the Swiss franc. These forex movements have a secondary impact on import-export businesses, altering price competitiveness and reshaping trade terms, which again circle back to consumer costs. From a behavioral finance standpoint, the 90-day delay also introduces emotional variables into investing behavior. Retail investors, who already grapple with media noise and market FOMO, may overreact to short-term dips or rallies. Media headlines speculating about post-delay scenarios can cause rapid inflows and outflows in sector ETFs, disrupt momentum plays, and distort price discovery. For long-term investors, the key lies in filtering signal from noise, separating political theater from policy direction, and anecdotal disruptions from structural shifts. As we approach the end of our exploration, the final 90-day countdown of any tariff delay must be evaluated through a multi-lens framework, one that incorporates strategic foresight, economic modeling, behavioral psychology, and historical precedents. At its core, delaying tariffs is a gamble, not just on economic data, but on human behavior and policy interpretation. It's a test of whether businesses will use the time wisely or waste it, whether consumers will spend or save, whether governments will negotiate or retreat to posturing. For the ultra-wealthy hedge funds and multinational corporations, the 90-day period becomes a tactical battlefield where timing is everything. When to buy, when to move money, when to shift supply chains, and most importantly, when to exit positions before the music stops. On Wall Street, traders and analysts work frenetically during such delays, constantly revising their projections. Equity analysts revise forward guidance based not only on raw inputs, but also on political developments. If a delay appears to be politically motivated, perhaps to gain voter favor before elections, it may signal volatility ahead. If, however, the delay stems from genuine diplomatic negotiations, analysts might cautiously revise their expectations upward. These subtle interpretations make their way into investment models, risk assessments, and ultimately stock pricing. Smart traders scan every public statement, every tweet, and every diplomatic gesture for clues about what happens next. The 90-day window becomes less about facts and more about anticipation, a dangerous but potentially lucrative game. In the fixed income market, Treasury yields often reflect sentiment about long-term economic health. During a tariff delay, yields might fall if investors expect that the economy is about to enter a volatile phase post-delay, signaling a flight to safety. Conversely, if the delay is perceived as a softening of trade tensions, yields may rise as investors shift back to riskier assets. Bond traders adjust portfolios with precision, shifting duration, rotating between corporate and government debt, and rebalancing exposure to inflation-protected securities. Institutional bond desks at major banks like Goldman Sachs or BlackRock don't simply wait for policy changes. They hedge, project, and adapt preemptively. And their moves often dictate broader market sentiment. Among retailers and manufacturers, the delay prompts both anxiety and opportunity. Retail giants like Walmart or Target may seize the window to negotiate bulk shipments at temporarily lower costs, creating a pricing advantage over smaller competitors. Meanwhile, niche importers, those dependent on specific suppliers or regions, face more complex challenges. They must weigh whether to expedite shipments, risking capital and storage costs, or wait, potentially facing delayed logistics and inflated post-tariff pricing. In either case, operations teams, legal advisors, and procurement specialists are tasked with playing a high-stakes game of economic chess where a wrong move could erode margins or disrupt quarterly earnings. One significant but overlooked area of this delay dynamic is tax strategy. Large corporations and hedge funds often use trade policies as a timing mechanism for revenue recognition, asset valuation, and international transfers. A 90-day tariff delay may be used to reclassify assets, shift profits across jurisdictions, or restructure intercompany transfers. Tax attorneys and multinational CFOs use such policy windows to reduce effective tax rates or take advantage of momentary regulatory arbitrage. For example, if tariffs are expected to resume in Q4, firms may recognize revenue in Q3 to lock in more favorable tax positions. These moves don't just affect the companies making them, they impact tax revenue forecasts, economic modeling by governments, and even GDP estimates. Another critical component is technology. Advanced analytics and AI-powered economic models are deployed during such policy delays to predict outcomes. Large trading desks and hedge funds rely on machine learning algorithms trained on past tariff actions to generate probabilistic outcomes. These systems analyze vast data sets, container traffic, customs declarations, SKU-level pricing from e-commerce platforms, and sentiment analysis from global media. In 90 days, these tools are not just supportive, they become essential. A fund using real-time data from Chinese port activity, South Korean electronics shipments, and European steel exports can anticipate whether this delay is being used to front-load trade or if it signals a real de-escalation. Such edge can generate millions in arbitrage or alpha. Let's not ignore real estate either. Commercial real estate, particularly warehouse space near ports, sees increased activity and speculative lease activity during tariff delays. Logistics firms look to temporarily expand storage, fearing post-delay bottlenecks. This drives up demand, affecting industrial REITs, regional economies, and even transportation infrastructure investments. For the ultra-wealthy and sovereign investors, this creates new temporary yield opportunities. Short-term leases, targeted infrastructure funds, or opportunistic buyouts of distressed assets that couldn't survive previous tariff rounds. It's a whole ecosystem operating on the edges of global trade shifts. In commodities, we observe rapid hedging during a delay. Steel, aluminum, soybeans, and rare earth minerals all react to both real and perceived changes in demand. For instance, if a delay applies to tariffs on Chinese steel, global futures may rally on expectations of continued supply. Simultaneously, domestic producers might see stock drops as their pricing power wanes. Commodity hedge funds capitalize on this volatility, taking long or short positions based on projected flows. Even geopolitical commodity sources like Russian fertilizers or African cobalt become relevant as supply chains reconfigure. A 90-day pause is more than breathing room. It's a volatile inflection point. And in the digital world, e-commerce platforms feel the impact too. Amazon sellers who source from overseas adjust pricing algorithms dynamically during these delays. Some sellers bulk order products to beat future tariffs and flood the market temporarily, lowering average prices and increasing competition. Others hold off, causing temporary shortages and price inflation. These microeconomic effects ripple up into macro retail trends, impacting consumer price indices and Fed interest rate considerations. The banking sector, while seemingly removed from trade tariffs, is also indirectly affected. Credit exposure to import-heavy sectors like fashion, electronics, or automotive spikes during a tariff delay. Banks must reassess risk models, adjust lending rates, and monitor non-performing loans. Some SMEs rush to extend credit lines during the delay, hoping to stock inventory, and banks become gatekeepers in this dance. Simultaneously, investment arms within major banks look at structured products that can hedge against post-delay uncertainty. These instruments, sold to ultra-high net worth clients or institutions, offer downside protection if tariffs resume or enhance yield if peace holds. Insurance markets also recalibrate. Trade credit insurers, shipping insurers, and supply chain risk underwriters adjust premiums and exclusions during tariff delays. Risk of delayed shipments, contractual disputes, or geopolitical interruptions increases, and that risk is priced in. For businesses relying on just-in-time inventory, any mistake during this delay could cascade into losses not covered under old policies. Hence, the demand for specialized insurance coverage rises sharply, presenting opportunities for insurers and risk consultants. Finally, we must explore the emotional intelligence of policy interpretation. Traders, CEOs, and retail investors alike must process uncertainty not through numbers alone, but through intuition honed by experience. Will the president actually reimpose tariffs after the delay? Is this a negotiation tactic? Will the public pressure influence Congress to push for softer trade terms? None of these questions have clean data points, and yet answers must be formed. This is where financial success becomes an art as much as a science. Those who excel here, who read between the lines of a press release, interpret the timing of diplomatic phone calls, and watch who's lobbying Capitol Hill, often win the biggest. In conclusion, the question, can delaying tariffs for 90 days actually save you money, doesn't have a one-size-fits-all answer. It depends on who you are and what you're doing with those 90 days. For billionaires, hedge funds, and multinational corporations, it can mean strategic repositioning, tax arbitrage, or seizing short-lived opportunities worth millions. For small businesses, it could mean the difference between surviving the quarter or falling behind. For consumers, it might just delay the inevitable price hikes or provide a brief window of savings. For governments, it's a diplomatic tool, a political maneuver, or a way to calm markets before the storm. But no matter who you are, one truth remains. A 90-day delay is never neutral. It's a countdown. And when that clock hits zero, those who prepared will profit, and those who didn't won't.